Welcome to the annual Foreign Policy Association World Leadership Forum. This morning's proceedings are decidedly economic in focus. We're delighted to have two very outstanding panels. The panel later this morning will be styled Global Economic Growth, and the first panel is the perennially popular Word from Wall Street panel, and we're delighted to have such a strong panel with us this morning. I'm pinch hitting for Matthew Bishop of The Economist. My name is Noel Latif. I'm president of the Foreign Policy Association. And rather than go through the bios, they're in your binder. I'm just going to indicate that we have with us at this time Sharmeen Mosavar Rahmani, who is the Chief Investment Officer for Private Wealth Management at Goldman Sachs, Henry Kaufman, President of Henry Kaufman and Company, Ethan Harris, Chief Economist, Lehman Brothers, and Chris Heisey, Managing Director and Chief Investment Officer with U.S. Trust, Bank of America Private Wealth Management. Welcome. We're delighted to have you with us, and we're going to start off with Henry.
You're starting off with me because of age. I intend to make it through this program. It's very nice to be here again with you, Noel. I'm going to talk about the financial setting and some of the unusual dimensions and challenges that are facing us today, and I'm allowed about 5-10 minutes, I understand. One of the challenges that certainly now sits in front of us has been the enormous growth of debt in the United States. Debt in the United States in recent years has grown more rapidly than the growth of nominal GDP. And of course, in recent years, and now it's been highlighted by the growth of debt in the household sector, particularly in mortgages. It's quite obvious that mortgage debt growth in the period ahead is going to slow, and that in itself will have a dampening impact on economic activity. Another sector where the focus has not been very great, but I think the sector will come much more into focus, is the corporate area. Corporate debt also has grown rapidly, but it's in the longer-term sector and beyond 1 year, and it's grown a lot with marginal companies. The big question, I think, confronting corporate debt in the period ahead is going to be the issue of the trend in corporate profits. If you believe that we're in for a period of somewhat slower growth in the United States, even avoiding a recession in the period ahead, spectacular growth in profits by the corporate sector is over. The question is, to what extent will corporate profits be squeezed, and is there a risk that corporate profits will flatten out or perhaps go down? That is a challenge to the corporate community, because if profits slow significantly, we are going to see a squeeze on the capacity of some corporations to manage their debt. There are a lot of heavily leveraged corporations. The focus has been on cash positions, which tend to be large and have been large over recent times in the corporate area. So these are two fundamental issues that sit in the dimensions of debt. But over the period of the last 10 years or so, in particular the last 5 years, non-financial debt in the United States has grown more rapidly, much more rapidly, than nominal GDP. That has been to the benefit of financial intermediaries, to say the least, because they have been involved in the transmission of this debt and profited from the transactions. A second issue that has come up here is the question of marking to market portfolios, assets that are being managed, that are in financial institutions, and how well do we do that? It's quite obvious it hasn't been done that well, because we've had dramatic readjustment in prices, and we've created esoteric credit instruments that are arcane in many instances, and credit instruments that really, while they can be marked, the real value of those credit instruments is difficult to determine. Can you really take a marginal bond and take the last price as the market value? The answer is no, and we've seen that here, certainly in the non-prime mortgage area. We've seen it in some of the leveraged areas involving corporations. It's an issue that's going to be focused on and it's going to be questioned, and that is an underlying problem for another serious issue that sits in the financial community, and that is quantitative risk analysis. We have become enamored with quantitative risk analysis, value at risk, which is based on historical data going back relatively short period of time and has not taken into consideration outliers. The whole theory of value at risk analysis, the role it should play in the management of portfolios, is going to come under question. It's going to be highly debated at some point in time, and it should be. It underlies all these decisions that involve trading opportunities. It underlies corporate financing decisions. And many of portfolios in the trading area, in Wall Street firms, in major financial institutions, there's value at risk, a quantitative analytical technique that is supposed to tell you what the probability of losses. And we've seen here in recent months that those systems don't work. The tendency is that most frameworks that involve value at risk analysis techniques tend to be uniform in most financial institutions. They don't deviate that much. So value at risk analysis in terms of quantifications has more uniformity, more short-term aspects to it, and therefore has serious risks attached to it. Another challenge, I think, that we face in the financial markets, in Wall Street, is the question that has been underlying the system for some time, and that is who really failed in their responsibility. Conflicts of interest. Conflicts of interest run deep in the financial community today. We've seen them in some firms that have put forth a whole series of non-prime hedge fund operations. They've sponsored them. They've underwrote those issues. They put small capitalization in. They transferred their own holdings of mortgage securities into them. And then there's been a problem. In the last since year 2000, when we had the previous problem in the financial markets, financial intermediaries have been fined over $30 billion for wrongdoings and wrong actions and irregular behavior. Now, that raises the final point which I want to make is, who is responsible for managing our financial system today? Well, the Federal Reserve has said, and one of the previous chairman, popular chairman, has said, we don't know what a financial bubble is, but we know how to deal with it once the bubble bursts. Well, then who is responsible? The current chairman of the Federal Reserve said, this is a problem in the financial markets that has to do with global imbalances in savings. Well, can you then walk away from the issue? Who is responsible for managing the financial system of the United States? I doubt that. There is a responsibility. Ultimately, the financial system functions on the creation of credit. And the creation of credit is the responsibility of the central bank. It can't walk away from that. That issue is going to come to the fore again. Now, of course, the Federal Reserve has come along and indicated that it is supplying reserves, trying to alleviate the problem. And it is alleviating the problem. But we're living in an economic and financial world where economic behavior has been somewhat more stable in the last 20 years. The recessions tend to be milder. But the financial markets have become, what I believe, more leveraged and in many ways more abused. So we will probably overcome this particular problem that we have at the present time. But the next wave of financial credit creation is something that we ought to consider that may again abuse the financial system and create even greater damage. And there has been no one up to now that has asked the question forcefully enough, either in Congress or in the academic community, as to who is really responsible for really overseeing financial systems, financial institutions, and financial behavior. We blame the rating agencies, and perhaps they should have some of that responsibility, because much of our financial system is securitized, marketable assets rather than non-marketable assets. But rating agencies are private sector institutions. The responsibility is broader. And over the next half a year and year or so, hopefully, we will dig into the issue of who is responsible for managing the financial system and limiting the abuses. And no answer has come forth. So let me stop right there.
Thank you very much, Henry. We have been joined by Richard Bernstein. Welcome. Richard is the Chief Investment Strategist and head of the Investment Strategy Group at Merrill Lynch. Richard, we agreed that we would proceed in this order here. So Charmaine has not had her chance yet, and so we will turn the floor over to Charmaine Mossavar-Rahmani.
Before I actually get started on the material I was going to cover, I just thought it might be interesting to give a little bit of perspective on some of Henry's comments. When I grew up in the bond business as a portfolio manager, we used to hang on every word that Henry Kaufman would say, but he was known then as Dr. Gloom, and I see things haven't changed. On a relative basis, just a couple of facts, because I think it's so interesting, and one of the reasons I actually put together a handout, I know it's meant to be a conversation, but I think with conversations you can look at a glass and it's good to see is it half empty, half full, and a conversation people can have a different perspective, but the facts are the facts. So I thought in terms of these comments about debt being a major problem, especially in the US, I think a couple of interesting points. One is the government debt. As you know, because of the great economic boom we've had for many years, the budget deficit has actually been reduced. And on the corporate side, in aggregate, in terms of corporate America, they have the highest levels of cash in terms of relative to their assets in 35 years. And in terms of debt as a percentage of their assets, it is actually the lowest, just other than a couple of years ago, the lowest in over 35 years. So while you hear these comments in some narrow areas, and Henry was quite precise when he said in lower credits they have a lot of leverage, but in aggregate, if you look at all of corporate America, that is actually not the case. Corporate America is in great shape. And in terms of their profit margins, what's been a little bit of an enigma, which is interesting, is margins today are at levels that we hadn't seen since the 50s and 60s. And in fact, if one were to think this is a period like the 50s and 60s, with low volatility of interest rates, low volatility of inflation, and generally low inflation, one can see that margins can actually stay at these levels. I'm not making a forecast whether they will definitely go down or not, but the level we see now is higher than we saw in the late 70s, 80s, and 90s, but is actually not that high relative to what we saw in the 50s and 60s. And so again, it's a matter of, I think, perspective, but corporate America is in great shape. Profit margins are high, but they have been much higher for decades in the past when inflation has been low. And so in terms of our perspective, are we in turbulent times? Our view, it's a resounding no, we are not. In fact, it's a little bit the press and the newspapers and the media that make such a big deal out of all of this. And I thought it might be helpful just to look at a couple of pages, just to put all of this in perspective. If one didn't know in the middle of August, if you looked at the newspapers or heard pundits on the matter, you'd think the world was falling apart. But actually, let's look at some facts. For some of you who are more quantitative, there's a bit more data. For those who don't want to be too quantitative, you can just look at the exhibits. But what we've tried to show you here is what has this volatility been like in the context of past periods. And what you can see is that even at the peak of volatility in the recent period, it's nothing compared to what we had in '98 and through most of the 2001 through 2002-3 period. If you put it in even greater historical perspective, going back to 1950, you can see the little blip we had in the last month or so barely registers compared to what we've had in previous periods. So what it is that we've had a little bit of volatility relative to a very calm period in 2004, 5, and 6. So we've been in a very smooth period, then a little bit of volatility, and suddenly people think it's a tsunami. It's just a ripple. And if you look at the actual returns in the marketplace, let's look at the S&P 500. Peak to trough in terms of returns, the S&P was down 9%. Year to date, up a little bit over about 8.5%. In terms of overall volatility, this is not a major downdraft. This is just something to expect in the normal course of events. In fact, for anybody who had a moderately diversified portfolio, even at the worst period we had in August, the portfolio would have still been up. So if you had a mix of some bonds, some equities, some hedge funds, some non-US equities, some private equity, real estate, etc., the portfolio actually would have been up. So the idea that this is an extremely turbulent time is a little bit surprising. And in fact, if you look at the credit markets, you can see that in aggregate, the credit markets are telling you that we're not in particularly turbulent times either. There are 3 charts on this page. The most interesting one, I think, is the second exhibit, looking at the spreads, meaning the incremental yield relative to treasuries of high-yield debt, so the lower credit quality that Henry referred to. And what you can see, the spread here is not even close to the long-term average. So people who are actually investing in these kinds of corporate bonds are telling you that the risk of default is higher than it was a year ago, but not that great relative to the long-term average. And what's even more interesting is in the emerging market area in terms of spreads. They're the lowest we've seen historically. And even with this volatility, you haven't seen much widening of spreads. I know my colleague Bob Hormats is going to talk a little bit about Asia, but that's basically because of the incredible growth that you're seeing in emerging markets, especially in places like China, etc. Now, I was trying to think, why is everybody so excited about just this volatility that we've had? Again, looking in aggregate at global savings rate, even in the U.S., everybody likes to complain about the consumer. The net worth of the average household in the U.S. relative to their income, other than for a brief period in the peak of the bubble, is at the highest we've seen, again, in 30 years. So, again, leaving aside the headlines, the facts are that corporate balance sheets are in great shape. The U.S. budget deficit relative to history is pretty good. On average, we've only had, I think, 2 or 3 years over the last 30-plus years where the U.S. hasn't run a budget deficit. So it's nothing alarming. So I was thinking, was it the volatility of the hedge funds? Was something going on in hedge funds? And obviously you've seen all the headlines about hedge funds, including our own, that was disturbing people. And I was looking at the correlation of hedge funds and saying, was there something there that was unusual? Was there a big change? And this is just an exhibit that shows how hedge funds, different kinds of hedge funds, have reacted with other parts of the market, and there's absolutely nothing unusual there as well. And in terms of quantitative techniques, people talk about VAR, the value at risk, but people in our industry are actually pretty smart. They are not wed to these quantitative tools. I can just speak about what we do at Goldman with our balance sheet. People don't just put together a quantitative model and say, okay, our value at risk is X, and think that that is the end-all and be-all of numbers. Firms like ours actually do a lot of analysis and saying, let's say the worst thing happened in every sector of the market. So what happened in 97, 98 in terms of the emerging market debt happens to us. What happened in late 89, early 90 in terms of the high yield market is what happens to our high yield portfolio. What happened in equities in 2001 and 2002 happens to that part of our balance sheet. And actually do scenario analysis and say, let's say the worst scenario in every asset class that we have seen over the last 20 years, 30 years occurs, and then put it all together. Is that something that we as a financial institution can withstand? And again, I don't know about other institutions, but I think people have actually moved beyond value at risk and are pretty careful and thoughtful about how to manage risk. And again, with the exception of a handful of hedge funds that got hit, most hedge funds actually year-to-date are positive and have returns in the 6 to 7% area. Now, from a financial conditions perspective, just looking at a host of leading economic indicators to get a sense of looking forward. Nobody in our industry has a crystal ball. None of us do. I think if you asked Bernanke 2 months ago, did he know that he was going to be easing by 50 basis points? He would have said no. So it's important to recognize nobody has a crystal ball. We all look at a handful of indicators. And what you see on this page is that globally, financial conditions are not tight, i.e., in our view, we're not looking at an environment where we would think we're going to go into a recession. Is U.S. growth going to slow down? Yes. 2% seems like a reasonable expectation for the next 12 to 24 months, but growth in other parts of the world is actually picking up and picking up quite significantly. And one can see what's going on in China as a perfectly good example. Again, my colleague Bob Hormats is going to talk about that a little bit later. So in aggregate, we don't think we are in turbulent times, and we don't think that we're going to go into a major downdraft in terms of the economy and its implications for portfolios. Thank you.
Thank you very much, Charmaine. I feel like I can breathe easier after hearing your presentation. We're going to turn the floor over now to Ethan Harris, Chief Economist at Lehman Brothers.
Yeah, thank you very much. I guess judging from how hard it was to come here today, that we're actually in the age of gridlock, I think, right now. But what I'd like to do is kind of build on the previous comments and also bring in Alan Greenspan's book, which I think had something to do with the choice of the title of our talk today. I think the starting point is to acknowledge that we may be going into an age of turbulence, but we're not coming out of an age of turbulence. You know, from the seat of a Fed chairman, it's always turbulent times. But if you step back and take an objective look at recent history, it's actually been a pretty stable environment. In fact, most economists refer to the last 25 years or so as the Great Moderation, a period of very low and stable unemployment, low and stable inflation, and moderate financial shocks. Of course, part of the reason the shocks were moderate is because the Fed rode to the rescue a number of times. So I actually don't think we're coming out of an age of turbulence. I do think we're entering a tougher period, and adding to what Henry was saying, I think in fact Alan Greenspan handed Ben Bernanke a tough portfolio. Because think about what happened in the last part of Greenspan's chairmanship. The Fed cut interest rates to just 1% and then very reluctantly raised rates, and raised them in the friendliest way they could think of. 25 basis points, no surprises, never deviate from that path. Assure the public that you're not trying to employ restraint. All you're doing is normalizing interest rates. This is the kind of super sugar-coated Mary Poppins monetary policy, right? And the problem with it was, as Henry suggests, is that this was in the context of an emerging bubble in the housing market. Now, Alan Greenspan has told us that the Fed tried to stop the bubble with their rate hikes, and you can't stop a bubble without killing the economy. And I agree with him. It's a tough job, and certainly the Fed did a reasonable job of monetary policy in the last part of his term. But I still don't understand why the Fed could never have raised by 50 basis points. Why did this have to be a completely shock-free, benign interest rate cycle? And isn't it dangerous for a central bank to repeatedly tell the financial markets, we can't see bubbles? In other words, we can't second-guess the collective wisdom of all the great minds in Wall Street, right? Well, the fact is the markets do go into bubbles, and the great minds often get off on a tangent, and speculation builds on speculation. The central bank should not be saying we can't identify bubbles. That's really an implicit message to people in the marketplace that go ahead and have some fun out there. So I think that I don't think it's an easy task for the Fed. It's very difficult. It's hard enough to manage the economy without having to manage asset markets. But I think the Fed's position of leave the markets alone while the bubble develops and clean up the mess afterwards is too extreme. They need to lean against asset market bubbles, provide some verbal resistance, and be a little more, let it enter into their policy decisions. So I think that in that respect, some of the turbulence we're seeing now is inherited from Alan Greenspan. It's also true that the Fed allowed the economy to overheat a bit here. So not only did Ben Bernanke inherit a bubble in the housing market, he inherited a mild inflation problem. And so the turbulence we're kind of looking at now is partly a legacy of the Fed. Again, the Fed isn't the main culprit here. A lot of this is internal dynamics of the markets. They're not perfect in spotting all the problems out there. So I think they deserve a small part of the blame, but I think that they certainly deserve a part of it. Now, going forward, I agree that the corporate sector's in good health, and we've had quite a massive profits boom and a very conservative run-up in the stock market. However, there's one part of the U.S. economy that is very sick and is not getting better soon, and that is the housing market. The expansion of credit to low-quality borrowers got way out of hand. We can spend an hour talking about why it happened. And the adjustment we're seeing in the housing market is only halfway through. And we're going to be seeing a major recession in home construction for another year. And all that talk about a soft landing for home prices, it's not going to happen. I would have argued a year ago that we could get a soft landing for home prices. Now I don't think it's possible. And the reason is that there's too much credit being pulled out of the housing market, and there's way too much inventory of homes for sale in the market. There's too much of a glut in the housing market. So we're going to, unfortunately, and I don't want to be the new Dr. Gloom here. I'm learning from the master here. But I think that the truth is that this is going to be a major weight around the economy going forward. So yes, we probably skirt recession. But are we looking at a pretty darn weak economy? Yeah. And should the Fed be cutting? They really have no choice. And I think there'll be more rate cuts out of the Fed. So I think that those are all important issues. But if you step back again and kind of look at the world from a longer historical perspective, we're not in an age of turbulence. The 1970s was a much more turbulent period. The 1930s much more turbulent. Even the 40s. But we're in a challenging environment, and I wish our new Fed chairman a lot of luck here. Thank you very much.
Thank you. Chris?
Thanks, Noel. I'm just happy I don't have to go last after Rich, but I will try to address three of the previous speakers' comments as concisely as I can. I'm going to take a little different approach from a global perspective and take a look at bridging the gap between what's going on cyclically and what we think is going on secularly. From the standpoint of turbulence, I would say that if we're not in an age of turbulence, then we should worry. But turbulence is really relative. I think if you sit in a lazy boy chair, an easy chair, and one that has a vibrating mechanism with it, the relevant shift to turbulence, you can feel it, and I think that's what we're feeling right now. Our position is this is not a liquidity crisis. This is more or less a short-term credit crisis. You can take a look at 3-month T-bills to see that, or LIBOR yields. But we have to address it, and the Fed is doing their job at that right now. Other central banks haven't followed yet, but we believe they will at least not hike, maybe possibly move towards an easing cycle themselves, like the BOE and the Bank of and the European Central Bank. I would say that from a cyclical perspective, our position is exactly in line with what Ethan said as far as housing is concerned. That is probably Pandora's box, but the box is going to be closed for a very long period of time. From a cyclical perspective, moving over to secular, the key to all this, I believe, is the fact that we're witnessing a massive growth shift. The mix of growth in the world has clearly shifted from the U.S. consumer to perhaps emerging market consumers, and we'll see this over the next couple of decades. But really, if you look at the country dynamics, I think we're all used to in the last couple of decades, perhaps longer, you had this dual relationship perhaps between Japan and the United States as it relates to global trade, as it relates to the flow of capital, and investors were used to that. When the U.S. made a mistake, Japan felt it, and vice versa, really since the latter part of the 70s. Now you have kind of a diamond approach. The diamond at the top is pretty much the emerging markets. You would suggest that China and India are the engines there. At the bottom is the oil-producing nations, which is a new entrant to this global flow. On the right-hand side, you can argue that it's Japan and Europe, predominantly Japan, and then you have the U.S. on the left side. These four areas of the world have to work in concert to move from a cyclical repricing of risk and a perceived liquidity crisis into a secular period of smooth growth. We think this can happen. It's going to happen over the next decade. It's not going to take a year, and no central bank in the world is going to be able to smooth this out as quickly and as less concerning as investors would perhaps want. So we do think we're in some sort of a turbulent time. But if you take a look at the emerging markets being at the top, you have tremendous difference in their balance sheet today versus literally 10 and 15 years ago during the LTCM and below that crisis and the Thai baht crisis in 97 and the tequila crisis in Mexico in 94. Tremendously healthy balance sheets. The emerging market consumer is now starting to get healthy. You're starting to see mortgage markets created in areas of the world that never had it before. Japan is now becoming a high-end producer of goods, not the low-cost producer. They're actually moving that machinery up to the emerging markets, and China is benefiting from that, sending the low-cost goods to all of the other three partners. The oil-producing nations have the chief energy commodity in the world, energy. They're exporting it to the three other areas as well. And the U.S. consumer is still the consumer of choice. So if these four areas don't work in concert, the secular growth shift that we just talked about is going to be extremely turbulent. And the one thing that can break this down is inflation hits China. Now, I don't know if you've seen it, but import prices as it relates to coming into the U.S. have risen dramatically coming from China. That's not as concerning to us. Food prices have risen dramatically. A lot of that has to do with supply shocks and other issues. But labor and wage costs are starting to tick up as well in China. It's getting concerning. We don't think it's a secular situation. But as long as a lid is on inflation in China, this relationship or this diamond approach is going to remain extremely healthy, and that secular growth shift is going to cause tremendous investment opportunities, not just in those four areas, but also here alone in the United States. Cyclically speaking, turbulent times, repricing of risk. We have to get through the securitization mess that is going on right now, and particularly in short-term credit. You probably will see some headline risk hit some of your more important papers over the next 6 to 12 months as it relates to housing, as it relates to non-traditional investment houses. But the reality is we're working off of very low volatility, as Charmaine mentioned before, and just a little bit of volatility feels scary to a lot of people. And this is probably going to be, in the next decade, the greatest investment opportunity time that we've witnessed really in the past 2 decades, predominantly because of that relationship that we discussed. Thanks.
Thank you very much. and now Rich Bernstein.
I apologize for being late, and I apologize to Henry for interrupting your talk, Henry. My definition of the productivity miracle is that I now have a BlackBerry, so I can email people to tell them I'm going to be late when I'm caught in traffic, and that's been the improvement in my productivity. I wanted to chat briefly about 4 different points, some of which have been talked about here. Point number 1 is volatility. And that was really our big investment theme for 2007, was that volatility would return. And there were 2 reasons why we thought that volatility would return to the financial markets. Number 1, there was a long-standing relationship between monetary policy and financial market volatility that basically argued that volatility would go up in 2007. Most people poo-pooed the analysis because it showed that there was a very long lag time, about 2-year lag time between monetary policy and financial market volatility. And everybody's reaction was, well, in this day and age, what could possibly have a 2-year lag time? Everything's discounted in the financial market so quickly. How silly to think that something would take 2 years. And we tried to point out that, gee, you know, the Fed started tightening in June of 2004, and it really didn't hit the housing market till June of 2006. That would be 2 years. So to think that there are still long lag times associated with this blunt tool of monetary policy seemed perfectly normal to us, and really the historical relationship, which was very, very strong, argued that volatility would go up in 2007, and a fact that argues it's going to continue through 2007, even into 2008. We will continue to see a rising trend in volatility. I'm not going to tell you I'm smart enough to predict the volatility of volatility, but we do think there's going to be a rising trend in volatility. And I think it's important to think about this within the context of the notion that volatility always signals a change in leadership in the financial markets. The growth story or the main investment stories going into a period of volatility are never the same stories coming out. And so we have looked at this period of volatility as a signal that the financial leadership in the financial markets is beginning to change. And the leadership stories of the last 5 years will not be the leadership stories of the next 5 years. And so what do we think are going to be the leadership stories of the next 5 years? Very much the opposite of what you've seen. We're expecting things like high-quality bonds to outperform over the next several years. We're expecting large-cap stocks in the United States to outperform over the next several years. We're expecting defensive sectors, things like healthcare and consumer staples in the United States, to outperform as opposed to some of the more cyclical sectors that you've seen. Here's the one that's heresy. We expect developed markets to outperform emerging markets. And we expect, for the truly risk-averse, we expect them to do quite well in cash and even high-quality dividend-oriented strategies. We think the stories of the last 5 years are not going to be the stories of the next 5 years. I can't emphasize that enough. What's the common theme among every growth story of the last 5 years? It's the credit bubble and cheap access to credit. Right? It is not a global growth story. How can it be a global growth story when we talk about China and we talk about U.S. small caps in the same breath? Right? In the United States, small companies perform the best. They're purely domestically oriented. At the same time, China's outperforming. How do you have a purely domestic U.S. story being the best performer in the United States and then this great global story? It is not a global growth story. The common thread there is access to capital. There's been a lot of work by my colleagues at Merrill Lynch that shows the number one factor influencing small cap performance in the United States is access and availability of credit. Think about the last 5 years. What have you had? Tremendous access and availability of credit. Think around the world. Every leadership story has been a capital-intensive story. Right? Think about energy. Think about commodities. Think about China. Right? They're all capital-intensive stories. And that makes a lot of sense when you consider the cost of capital was basically made free. Right? When the cost of capital is free, when the hurdle rate, Fed funds rate goes to 1%, capital-intensive stories should do very well because the cost of capital is remarkably cheap. We think the volatility is telling us the cost of capital through time will be going up. Financial markets will be pricing capital much more rationally than we've seen, and those capital-intensive stories are going to be hurt the most. Now, that doesn't mean they're going to go away, but it may mean they underperform in a relative sense, but we don't think they're going to be the leadership stories. And I could go back and people say, well, how could this be? Look at the emerging market stories. Well, think about 1998. Right? 1998 was going into 98 was a big emerging market story. Coming out, it was U.S. large cap technology shares. Right? It was not an emerging market story for the next 5 years. It took about 5 more years, and then we got to another emerging market story. So this is not unusual. it happens every time you see volatility that leadership changes in the marketplace, and we expect that as well this time. I think I mentioned 1998. I think point number 3 is we have to try to decide right now if we're in an environment like 1998 where the Fed overreacted to a financial situation and we ended up with a technology bubble, or are we looking at something like 1989 where the Fed eased interest rates but credit conditions remained very, very tight and got tighter and tighter and tighter, and we ended up with a consumer-led recession, real estate problems, and that sort of thing. I think, by the way, the kind of cute mid-cycle pause analysis is very cute. I think it makes people feel good. I think there is absolutely no relationship to what's going on in the current economy. There is nothing today like 1995. I think there's no similarities at all. 1998, again, Fed overreacts, but 1989, it doesn't really work. I actually think, unfortunately, we're in a 1989 scenario. I think there are many, many similarities to 1989 in terms of we had an LBO and M&A boom. We had a real estate boom. Maybe the contours of that real estate boom were a little bit different now than they were in 1989. And we had an Asia story. That's the one that people don't remember. The Asia story was not China, it was Japan. And people say, well, but the Nikkei never went up the way the Shenzhen index went up. Yeah, but the JASDAQ index did. The speculative Japanese companies went up 4 or 5 times in a year in 1989, the same as China has today. And if you remember back then, the story was that we should all learn Japanese. You don't hear too many people saying that today. So clearly there are differences between China and Japan. I'm not trying to equate the two. Don't misunderstand my point. But I think there are many similarities to 1989, and I think that's kind of the risk. Well, the markets have kind of treated it as though it's 1998. The Fed has overreacted to a financial event. Every risk trade around the world has begun to outperform since the Fed initially cut the discount rate. In fact, we wrote about that and we said, my words, not exactly what we wrote, but Mr. Bernanke, did you notice that you've cut the discount rate and commodity stocks are leading in the equity market? It's not financial stocks. We thought the whole point of cutting the discount rate was to help the financial stocks. They've been among the worst performers, and meanwhile, the commodity stocks have been among the best. The markets are treating this very much as a 1998 type event. We're not so sure. We're not so sure, and therefore we think those 5 themes are going to outperform. Final point I want to make very quickly. I'm surprised nobody mentioned the dollar. Because I actually think that's one of the biggest issues right now. Or maybe, Henry, maybe you did before I came in. But anyhow, but I think it's one of the biggest issues right now is the dollar. And I think it's important to remember that when your currency depreciates, your standard of living goes down. And I think in a very odd sort of way, this is going to be the main issue in the 2008 elections. Not in terms of everybody's thinking of the dollar, but in terms of our standard of living going down. It was mentioned before, average net worth is the highest in U.S. history or whatever the statistic was. That may be true. Unfortunately, it's the median that makes a difference for elections, not the average. It's the median that actually votes, not the average. And the median is not doing very well right now. And the median voter, I think you're going to hear a lot as we roll towards 08 in terms of the historical disparities in wealth, historical disparities in income. I think you're going to hear a lot about protectionism. I think this GM strike is another symptom in that process. It's not in and of itself. It's just another symptom of the disparities of wealth that are going on in the economy. And I think as we roll towards 08, that's going to be a huge, huge issue. What's going to happen with the dollar? Well, our FX team is basically predicting continued weakness in the dollar. Of course, you can have ripples up and down. My personal feeling is the dollar will remain weak or generally weak until we clean up our monetary and fiscal policy. If the IMF goes to Argentina or Malaysia, and we'll always tell them you have to clean up your monetary and fiscal policy. The good thing this time is the IMF's in Washington. They don't have to pay any T&E expenses to go help anybody clean anything up. They just walk across the street. And I don't think we should expect any real strength in the dollar until we clean up our own monetary and fiscal policy mess. But I think the main thing I want to leave you with here is volatility signals a change in leadership.
Thank you very much, Rich. I'm going to press the panel on 2 issues, and then I'm going to open it up for questions and for questions from the panelists to each other. The question that Henry posed, who is responsible for managing our financial system, is, I think, a very important question. And I was wondering if the other panelists would like to weigh in on that. Do you feel that There is inadequate regulation of the financial system. Are the central bankers inadequately equipped to address crises in the financial system? Should we start with you, Ethan?
Well, as I said, I think that the argument that the Fed just steps aside and watches a bubble because it's too hard to identify and too hard to manage, I think it's just too extreme a position, and they really should try to lean against and mitigate these asset market bubbles. So that's part of it. The other part, and again, a lot of this is concentrated around the housing story right now, but we know that the bubble in the housing market was driven in part by investors piling in, looking for yield, eagerly grabbing up all this low-quality debt. And on the other side of the pipeline, you had the brokers out there finding low-quality debt and putting it together into packages and selling it to these eager investors. And part of what we know now, and I'm not an expert in regulation, but certainly the way the mortgage market's regulated at the retail level needs to be fixed. I mean, there's too many different regulators. Nobody's really in charge. You've got this distinction between state regulation and federal regulators. And you just need a more organized regulatory structure so somebody really is in charge there. And I don't have a specific solution. I think that we're going to move in that direction. It has to be a federally driven regulatory process because that's how you get consistency. If the individual states are competing to see who can be most loose in their standards, then you have a real problem. So yeah, definitely in the mortgage space, we need better regulation of mortgages.
Thank you. Charmaine, do you want to weigh in on that? Do you think that the system is up to the challenge?
I think having these small episodes of, and again, in the context of the global economy or the context of a $7 trillion global economy, these are little ripples. And to think that these shouldn't exist and it should be smooth sailing all the time is just unrealistic. And I think there's plenty of regulation. And the fact that in some corner, and people talk about housing broadly, you could go to Michigan. I'm sure nobody in the Detroit area thinks there's a housing bubble. You could go to Massachusetts. Massachusetts housing hasn't been in a bubble for years, and that's because of population growth. So are there some pockets in Florida where there's a bubble? Yes. Are there some areas where there are small dislocations? Yes, but to over-regulate so broadly to prevent some of these dislocations from occurring is just not reasonable. I think human nature is fear and greed, and so on the fear side, people will overreact, just as they have a little bit to what happened over the last couple of months, and on the greed side, things will get overvalued. But if you think of regulation, if the economy is growing at a moderate pace, if the tightening has actually already slowed the economy somewhat, why do we need additional regulation? So I think we have plenty of regulation.
Thank you.
Something like that idea.
I'm going to switch to the other point.
Can I just make a
yes,
comment
Henry.
on this issue because you reverted to my view on this. I think there is a serious fundamental issue underlying here, and that is how do you discipline financial markets and financial market participants? And in a completely democratic economic society, the answer is those who do well prosper, those who do poorly fail. But in our financial system, the way we run it, that is not the case. We do not allow large financial participants to fail. We allow small participants to fail. And that creates a system that in the long run cannot function well to the benefit of society, because smaller institutions will disappear, larger institutions will become more amalgamated, and therefore will not be able to run a real free financial system. And we have not overcome this. The Bank of England just rushed to the aid of a bank. Long-term capital management was not allowed to fail. Not allowed to fail because participants that were lending and involved with long-term were twisted to help keep it afloat as such. And this goes back in our history that in the post-World War II period, we do not allow large institutions to fail, either here, in Europe, or Japan, or anywhere else. Now, over the long term, and over the long term we're all dead, but over the long term, we are going to change this financial system to the detriment of an economic system, a free, democratic economic society. Now, that's the underlying long-term issue. We will not deal with it over the short term.
May I just make one statement, though? I think long-term capital did fail. For anybody who invested in long-term capital, their assets went to zero. What happened was the Federal Reserve Bank of New York decided that for them to unravel and unwind their positions would be broadly disruptive, so they asked a handful of firms to help make the unwind more orderly. That was the extent of it, but long-term capital, by all measures, failed. The assets of all the investors went to zero, and as an entity, it doesn't exist anymore. So it did fail. It was just that the process of failing was done in an ordinary fashion, not to be disruptive to the markets.
Let me come back to it. I'm sorry to really belabor
Makes
this
a conversation.
I had this discussion with the former chairman of the Federal Reserve, and where the question was raised, there are large institutions in the United States, we don't allow them to fail. And the response was, well, we don't allow them to fail, but the management can be removed. The depositors, if it's a deposit institution, will not be allowed to fail, but some of the managers in the middle may be removed. So there is a disciplining factor. The answer is wrong. And the answer is wrong because in the process, before that institution is disciplined, before Citigroup, which nearly failed, slowed down its process, and in many of the large institutions slowed down their credit creation, they created unnecessary debt. Debt that should not have been created if they had followed a disciplined credit creation process. And they were allowed to create excessive credit to the detriment of our society. And that can't be negated by this argument here that everything moved along smoothly and the market adjusted. The market did not adjust. The Federal Reserve allowed major institutions to continue to function and did not allow them to fail.
Thank you very much, Henry, for that point. And I've always been fascinated by the too big to fail doctrine. I'm just wondering how it's implicated in the current housing market crisis, and whether, Richard, you'd like to comment on Ethan's prediction that we're not going to have a soft landing in housing.
Mm-hmm. Well, our chief economist, Dave Rosenberg, is probably now the most bearish guy on the street and probably has been for a while. And Dave's theme has very consistently been that housing was a bigger boost to the economy on the way up, and it will be a bigger boost to the economy on the way down. If you take into account the leverage that was used and the debt creation that Henry talks about, that stimulated the economy, and Dave and I would argue the global economy more than people think, and therefore as housing prices come down, we'll see it in the reverse side. I think the key. I agree with Ethan. I don't think anybody at Merrill will say that we're going to have a soft landing in housing. I don't think that's been a pretty standard theme of ours, that we were going to have a housing recession. I think the question, though, and the difference of opinion within the firm revolves around how quickly this manifests itself and how deep it is. And for that, I think we're all watching some of the employment statistics pretty closely. I think the data show pretty clearly, unless you want to posit that home prices are going to fall 25%, which maybe they will, but let's for a second assume that they're not going to fall 25% on a national basis, the number one factor affecting foreclosures is employment. And so far the employment data have been mixed, I would say. If you look at jobless claims, they've been in a range for quite some time. Obviously, payroll employment, we got our first negative number in a long time. But I think if you're worried about that, that's what I would look at, and I would try to look at all the leading indicators of employment. I think that will tell us whether we're going to have a really hard landing or not.
Chris, do you want to comment on
I
that?
think I would add to that, precisely the same point. I think the R word that everybody talks about, the famous R word, is going to be just, contingent in the housing sector itself. But if you take a look at the entire economy globally, I think the real R word is reflation again. We're living in another period of a reflating mechanism around the world, which shifts capital to where the greatest risk-adjusted returns are. And I would say that one mechanism to look at is the price of gold in relation to the two largest asset classes in the world, which are equities and fixed income. And if you plot the price of gold versus equities since the year 2000, it's dramatically outperformed in an age where inflation was not a problem. I mean, that just doesn't happen. Same thing against fixed income. It outperformed fixed income in an age where there is no inflation per se. You can argue that cyclically there's a little bit right now, but secularly inflation's low. So that means, in our opinion, that there's this massive economic transformation going on where there is a growth shift. So housing in the U.S. should contain the recession there. The Fed should do its job and stabilize the credit markets, cause risk-taking to come back into the markets, perhaps as we head into the first part of '08. The real question, I think, is what Rich mentioned before, and I think Henry as well, is what happens to the profit cycle in the U.S.? What happens to financial earnings? Can energy earnings hold up? And collectively, if you get $100 of S&P earnings with a multiple of some 16 times, you're okay. So the broader question, I think, is to ask ourselves, are we looking from a global perspective of the age of reflation coming back with recession contained in the housing argument?
Thank you. Why don't we open it up for questions from the audience? Sir? Yes, please.
I had a question about the currency, and you're talking about gold prices. I'm just wondering, in the Western states, you've had a real, ignoring the resources there because you don't have a N43-101 standard here, like you do in Canada. For those who don't know, that means they accept what's in the ground, and you don't have to disclose it. It's actually accepted. And you've got anti-leaching laws in Montana. We have environmentally friendly ways to extract gold now, and there's tremendous resources out there. Claims have lapsed, and I just feel like in the coming years you're going to see a lot of companies out there that are grabbing up these properties with the gold price being so attractive, more money being spent on extracting above ground resources and exploring for below ground resources in those areas. And that further flows into, you're talking about India and mortgage and the corporatization of real estate. That's something that our group's been involved with since '99 on a very strong level. And you might want to add another component to your diamond analogy and look at Canada and how they environmentally responsibly manage their natural resources. They help shortfall in the U.S. with natural gas and oil. And look at all the oil you have in shale, oil in Colorado. I know the government is leasing out land right now to neighbors.
Could we have the question, please?
The question is, how do you think that that's going to help the currency in the coming years? The Canadian dollar is right there on par now, and I think that's a big reason for it.
Rich, you brought up the currency issue. Do you want to make some comments?
I would actually say, I think to some extent you're looking at this backwards, with all due respect. I think if you were a commodity investor in Europe, last 12 months you're very upset. You're down about 10 to 20%. So I think it's not, I'm not, as I said, I'm not as big a fan of the global growth story and the global demand story as everybody makes out. I think a lot of it, certainly there is some global demand, don't misunderstand my point, but I think a lot of what we're feeling in the United States is a dollar issue and not so much a commodity issue. I do think many of the markets that you've mentioned in commodities have gotten very speculative, and we have actually been suggesting that people begin to lighten up. Outside of a dollar collapse, obviously, but because we think that by our reckoning, commodity prices right now are about let's say roughly about 20% above where they could be, where they would be if they were based purely on fundamentals right now. And so that's pretty high relative to history. And so I think this has been more of a dollar effect than people think, and maybe has become a little more speculative than people think. I think it's important to remember commodities troughed in 1998. It's not a new story from that perspective.
Charmaine has a follow-up question for you.
I was just wondering, since you brought up commodities and talked about the rotation from what we've seen for the last 4 or 5 years, then would you think commodity-related stocks will basically underperform energy, mining, etc.?
Yeah, exactly. That has been one of our calls. We made a big call on energy and commodities in 2000. Largely, we thought that they were going to be one of the big themes of the decade. We had several, but that was one of the big themes of the decade that we thought. And it was really kind of based on a scarcity issue and a lot of other things. Little did we know Fed funds was going to 1, and it would spur everything to what we saw. But yeah, we have been suggesting that people sell commodity stocks, they sell commodity countries, things like that. Not in a massive sell-off. Don't misunderstand my point. But I think our story has been, if you've got gains in commodities, if you've got gains in commodity stocks, it's probably worthwhile to look elsewhere now for those opportunities.